So why does this business exist? Old people in Australia are quite wealthy and in their retirement can realise some of the equity in their home and use that to spend to fund their retirement for lifestyle, etc. So when you move into one of these places where they've essentially converted a sheep paddock into a caravan park, and I say that because it actually operates under legislation for caravan parks. The CEO of this company was actually head of the caravan park industry group for Australia. There's a few things that they can arb out here to make it cheaper. There's no council rates, there's no capital gains on sale, etc. And importantly, compared to a retirement home, you don't have an exit fee when you sell the property, which is usually when the person living in it dies. So the majors in Australia, Ingenia, listed company, Moffatt, Stockland, I think that's it. Hometown's one of the largest as well, and then Lifestyle. So, as I said, key with these properties, which is kind of like a intermediary between retiring and dying. None of them have, or they're part of the value proposition is they don't have an exit fee, which is in this case referred to as a deferred management fee. So nothing for Ingenia, Stockland, Gem Life, Hometown, etc., except Lifestyle, who charges 20% of the property sale, which is escalated at 4% a year, capping out at 5, capping out at 20, which is roughly after 5 years. So we've done an example here on what it costs to live in one of these properties, chosen Geelong because that's where old people like to live.
So what does it cost to live in a lifestyle community in Australia? Retirement age couple, capital growth of 9% CAGR, they're going to live there for 10 years before they move back in with their children or they move off to a bona fide retirement village.
So their homes must be cheaper then, right?
So in Geelong, there are 3 like-for-like communities operated by Lifestyle and their 2 listed competitors with segments operating land lease communities, Stockland and Ingenia. For a 3-bed, 2-bath, 1 car, Lifestyle will charge you $750,000 Australian dollars. Stockland will charge you $699,000 and Ingenia, the good folks there, will give you 2 carports in the same home for $699,000.
So the fees must be lower, right?
Well, no, they're not. So the business model is to charge around $250 a week before any Commonwealth rent assistance entitlements. Lifestyle will charge you $245, Stockland $250, and Ingenia $242. Remembering that the couples buy the home and lease the land. This is what they're paying for the land and the community infrastructure. Over 10 years, the difference is negligible. But let's look at the exit fees. After living in a lifestyle community for 10 years at a 9% CAGR, you're going to pay $355,105 just at your most needful time of life as you're moving back in with your children or into a residential retirement village. With Stockland or Ingenia, on the same home that you paid $51,000 less for, you're going to pay $0 of your capital gains as an exit fee. Here's the difference in capital gains between the 3 offerings. And the total cost of ownership. So to live in a Stockland or an Ingenia property in Geelong for 10 years, you're going to pay gross $130,000 for Stockland and $125,840 for Ingenia. With Lifestyle, you're going to pay $482,505 at a 9% CAGR. So let's take a moment to remind ourselves a simple lesson from a titan of our industry.
Here's something they didn't teach you at Stanford, Ben. Whenever you can, put a company in your mouth.
So I guess the key question is to ask yourself, which one would you recommend to your folks?
Our conclusion is that Lifestyle Communities' product offering, once the leader in the sector, is no longer competitive.
And this is starting to be realised. The company's performed very well over the past decade or more, but cracks are starting to form.
So management guided that customers were telling them they were looking forward to settle their homes in the seasonal selling season in Melbourne. They missed their guidance, but said that these were going to come in that half.
But settlements actually fell in the second half, or in the first half of 24. which led them to renegotiate their debt covenants, raise equity, and revise guidance down, which is something they have not had to do over the past handful of years prior to COVID, where they enjoyed rising prices, etc., and have now changed their guidance to being non-explicit for given periods. Well, not much to see or say here. First half earnings were catastrophic. And the key thing to take away from there, and if you look at essentially all the commentary around it, they've actually now conceded that they've pushed out settlement times by a further 90 days. It's unlikely that this will be the last downgrade.
So sales appear strong, right? But let's explain the difference between sales and settlements at Lifestyle. As a customer signing a sales contract with Lifestyle, I'll speak to the audience's language here. You're buying a call option on a home. You're paying $5,000 Australian for the option to buy a home when it is ready or some point following that. That's not a sale. The settlement rates for Lifestyle's 3 most recent communities, as you can see here, are substantially lower than the average settlement rate from 2H 17 to 2H 21 vintage projects. LIC further updated their purchase agreement in July 23, and we see from our analysis of that agreement that they're incentivising the purchase of inventory homes, meaning they have an inventory issue which affects their working capital cycle.
So as I mentioned earlier, this has really been a growth industry and the company's got a multiple to reflect that. But that doesn't address at all and factor in the increasing competition coming their way. They've gone from being a leader in this sector to a middling company.
So we're going to move quicker because we're only halfway through our presentation.
Let's light a fire under this.
So what are the implications? Let's talk about their dividend. It's paid from community management cash flow, which is the cash flow they generate in their business, excluding the cash flow implications of development of housing projects. Let's break out what that community management cash flow looks like. Here we have the DMF in pink and the real community management cash flow, ex-DMF, in white. Let's see what happens to their dividend if they drop the DMF facing this competition.
That's not good.
So how about that $1 billion investments line on their balance sheet?
Yeah, but how about the cash?
Listen, mate, what are you talking about? Cash. There's no cash here. Here, there's no cash, all right? Cash, no. Robbo? No cash.
We apologise, Katarina, we need a couple more minutes. So back to those investments. Accounting. Lifestyle values its investment properties in 2 ways. It uses a discounted cash flow method for the expected deferred management fees, read exit fees. That's the 20% they take when you sell your home. And they use a capitalisation method to value the rental cash flows produced by its communities. But it's a bit odd. So taking the capitalisation method, we can back out the input of the net operating income per home that they're using to gain the valuation of their rental property portfolio. It's a bit strange that if we take that net operating income and divide it by the FY20 homes count, it still exceeds the gross margin per home of rental from FY23.
That's odd.
It's a bit strange. Cap rates. We don't know if anyone's done the work here. Unfortunately, we did. Did you notice anything? Let's try again. LIC's cap rates contracted 131 basis points from FY20 to 23, while the risk-free rate climbed 299 basis points, and their own cost of debt climbed 161 basis points, fooling some of the people all of the time.
So whether you're a resident or a shareholder, it seems like lifestyle communities might just be the only way that you can lose money in the Australian property market.
Thank you everyone for your time.